Hello and welcome to the download. I'm your host, Dave Richardson, and we are live and in color on a beautiful Stu's Day. Stu Kedwell, co-head of North American Equities at RBC Global Asset Management. Should properly introduce you at least occasionally, right, Stu?
Well, thank you, Dave.
I know your mom's had some complaints about my treatment of you and the respect and deference I'm showing you as a big power player in the Canadian investment industry.
Maybe just my mom, Dave.
Yeah, probably just your mom. And by the way, my mom's got some issues with you too, so it's all fair.
Okay.
But anyways, we'll get to what people want to hear about, because it's just been a really crazy week. If we go back to so we're taping here on Tuesday, August 13th, and we go back to the first Thursday, Friday in August, and the Friday in particular where we had the jobs report. Big drop in stocks, followed through on a Monday with a big drop, and then a recovery last week that took stocks almost back to where they were. And now we've seen a really nice first couple of days this week. What are your? I know we talked about short-term volatility and reasons why volatility would pick up at this point in the summer. There's a seasonal element to it. Different stocks where their valuations are particularly sensitive to bad news when bad news is interpreted as bad news. But we didn't think that this was some kind of unwinding of the bull market, and that's exactly what's happened, right, Stu?
Well, yeah, I think when you look backwards, you always know exactly what happened, right?
Yeah.
So sitting here today, we can look back on the last couple of weeks and say, there was some building concern around the economy slowing, and then Japan tightened interest rates, and it set off some unwind, in effect, kind of like a margin call on some positions that had to be unwound into this, kind of changing sentiment. Like all activity like that, it's pretty fierce, because it immediately moves assets to prices that people are willing to kind of pay.
Yeah.
And then as it passes, it kind of rallies back, and then on Thursday, the unemployment data from the United States was better. And so until the kind of more aggressive unwind, the discussion in the market was the economy is slowing, how quickly, type of thing. And when there was some weak employment data from the non-farm payrolls, which is kind of done on a monthly basis, that triggered some angst. Then the weekly basis wasn't quite as bad, and we have this kind of push and pull about the economy slowing. And we've just had our first day of what we call our risk committee, which is kind of all the kind of resources of the firm sitting in one room. And the discussion points that really come into play are, first, inflation slowing is pretty important. So, often when you get into these types of situations, you want to kind of reverse the question, right? So we think inflation is slowing. What would be top of our list that would cause a reacceleration? And, top of that list, kind of at this juncture is some of the global tensions and what could they do to the price of energy in the near term. I think, that's top of the list. The second thing is, if the economy were to slow down more than we currently anticipate, how significant would it be? Because we've had days in the last 2 weeks where people go soft landing, hard landing, and how hard is hard and how soft is soft. I think we gotta have a little bit of a discussion around that, because at this juncture, the debate between soft and hard landing is very quite tiny in our minds, right? Like it could be by definition hard or soft, but it's not like this kind of big plunge in economic activity, which is pretty important. When we think about the earnings backdrop, and the reason for that is because central banks have the capacity to lower interest rates, which then leads to the next spot, which is where you get into fixed income, where central banks have the capacity to lower interest rates. They haven't done so yet, but bond markets have predicted that to some degree. So the prediction by the bond market that central banks might lower interest rates in effect eases financial conditions, which then raises the odds that it's not as hard a landing as some people might worry about. And there's a lot of circularity to this, this type of discussion and the way markets function. And so that's been one of the features of today.
Yeah, I was having dinner with a colleague last night, and we got into the debate around the call for a soft landing versus recession. And there was a little bit of I don't know, it was a frustration that there's still a recession call out there, or people are still putting a significant amount of a percentage of a chance that there's going to be a recession. And my counter was exactly what you just talked about: is we knew through all of this interest rate tightening, after we see a spike in inflation, the design is to tap the brakes on the economy, slow things down so that those upward pricing pressures can come off. And in doing that, you're likely going to see some people lose their jobs. You're going to likely see the economy slow. And then you end up with, oh, we can have a soft landing where growth is, 0.5% or below 1%, or we can have a recession where we technically fit the definition of a recession, where we have two small drops over two consecutive quarters of below zero growth. But the difference between the two is not that material, and so you're kind of debating. You're almost saying the same thing. It's kind of like an argument with my wife. But there will be a winner in this argument. It'll be a soft landing or a recession. In the argument with my wife, she always wins, and rightly so, by the way, because I'm usually wrong. But that's we're just really on the line. So it's not really that critical. And then what you say is, well, what are we ultimately looking for to spark the next phase of the recovery that the market's already looking at? And the bond market's telling us that. The bond market's saying rates are going to be coming down, right? And so that should spur on the next wave of growth, which is really what we should be thinking about from an investment perspective.
Yeah, no, 100%. And, even, just to kind of bring it close to home, like if you had, kind of a variable rate mortgage in Canada and you were staring at, prime rates of, 6.5%, 7% to, whatever it was, 12 months ago. Today, prime hasn't fully come down, but you can now get, a 5-year mortgage. You could lock in for 5 years at, 4.5, 4.75 or something like this. So, that delta is quite a change relative to what people thought might happen, even if it never did happen, right? Like, the whole idea around markets is that at any given point in time, they need to kind of affect or reflect the odds of a variety of scenarios. We know that the outcome at the end of the day is discrete, but until then, we have to shift odds, and that's prices moving around. And it creates volatility. It's uncomfortable, but it's the way of kind of dealing with new information as it finds its way to markets.
And we did come back again with a discussion last week around dollar cost averaging in the face of increased volatility. It looks like that increased volatility is going to remain there. Now, it's come down from the levels that we were seeing in the middle of the day last Monday, but it's still elevated from where we had been through the year. I was actually looking at a chart of the VIX through the year, and it's almost a flat line in around 12 to 15 through the first part of the year. And then you see that spike up to, I guess it kissed 65 at one point last Monday, and it's drifted down. We're sitting around 20 right now. But again, that is elevated from 12 or 13 and very stable where it was before. And as we go through that period where some good news is good news, some good news is bad news, some bad news is good news, some bad news is bad news, that whole cycle where
Yes,
things are coming out and it moves markets, that it's not surprising that you're going to see some volatility. And again, as we were talking about, looking for opportunities in that volatility, but if we're long-term investors, recognizing the direction we're going longer term has become more clear, and then in the interim, using that dollar cost averaging strategy to build your positions so that you don't get whipsawed by any volatility that does take place over the next few months.
Yeah, no, 100%. A lot of people, like, nobody likes volatility because they watch their account go up and down. They watch their share prices go up and down, all sorts of things. But, personally, I embrace volatility. Like, it's when there's the most things to do. it's so as a money manager, it's not such a bad thing.
Yeah, like I mean, for you, as you say, you and again, this is such a this is where the what as you just said, volatility creates opportunity, right? Because things are moving, and when things
Yep.
are moving, that's going to create opportunities for you. Because things are very quickly. I mean, last as some of these big stocks that were falling because they were the stocks that people had been using this carry trade to buy. They get called, and you say it falls down to a position where someone's going to buy it because it's no longer super expensive. It's now at least somewhat reasonable. That creates an opportunity, right? And what you need to be able to do as an investor, and this has been an ongoing theme. So what's the difference between Stu and someone who's just starting to invest, or maybe they invest quite a bit, but that's not what they do for a living? They've got other things they're interested in. Not Stu, who's 100% focused on markets and very dull and boring all the time, right? It's that lack of emotion that Stu brings to the table as an investor, and that's one of the things you want to learn. Don't let emotion drive your decision. Just because there's volatility doesn't mean there's something you have to do, but it could present an opportunity if you're able to shut down the emotion, take that step back, take a deep breath, analyze, and see where the opportunities are. Of course, your advisor can be a key part of that as well. But that's what I see from being able to spend time over the years with people like Stu, and we've had Dan Chorness and others on this podcast over the years. It's that lack of emotion around these kind of times. Their ability to just always shut down the fear or the exuberance, depending on which way the market's going, and to just fall right back on to their analytics, their process, and the way they define those opportunities to take advantage of anything that's going on in markets. And that's, you see, you can actually, and this is good because you can actually see it now on the screen. I've been talking about this when we've only been on audio, but now you're watching it on the YouTube channel, and you can see that complete lack of emotions, or occasionally gets angry at me. But other than that, there's the complete just it's just a calculation.
Well, and I think the thing is too is preparation means envisioning that all sorts of things are going to happen. So even last week, like without predicting when the yen carry trade might have some bumps, there was a pretty general awareness that it was a little bit longer in the tooth. So just like your favorite sporting event or whatever it might be, like when a football game gets down to the 2-minute warning, they got the 2-minute warning playbook. They got get playbooks for all sorts of things that can happen. Yeah. So you kind of imagine this stuff happening before it does, and that in and of itself is pretty settling. So and that's half the battle.
Yeah, and again, I'd encourage anyone who's just new to the podcast, and again, we keep getting lots of new listeners and watchers every week. Go back and listen to some of the classics from Stu's days in the past, where you really see where we talk at different points about process. And we'll continue to do that. We'll do other different Stu's Day editions where we talk about a particular process that's followed at a particular time in the market. But from an investment perspective, this idea of the dollar cost averaging, particularly when markets are expensive or volatile, has been kind of a hallmark of one of the things we've talked about as something you want to watch for as an investor. And then last week gave you a great example of that.
100%.
Now, the other thing we're looking at today, Stu, because this was a really interesting one, and just because of the way the stock moved, and this one's always fascinated me. So we'll dig into this, and I know you've got a perspective on it. But the CEO of Chipotle Mexican Grill, right? It was announced today that Starbucks has basically recruited him over to become the CEO of Starbucks. And Starbucks stock has jumped.
Yep.
Chipotle stock has fallen, and it's not by a small amount either. These are fairly big moves, right?
Yeah, they're big moves, and it does. It's maybe not a perfect segue, but when we were talking about the economy and central banks and what have you, they're doing the same things that management does of business, right? Like they're always trying to figure out like how do we steer it as best we can. And boards of directors and shareholders and management of companies are doing the same thing. So a company like Starbucks, which has struggled, coming out of the pandemic with some of the traffic issues, and you do your morning espresso, and you've been to a lot of the finest coffee shops that you could ever imagine, and there's not as many Starbucks on that list as there used to be, I'm sure. Maybe I'm not even sure if Starbucks was ever on your list,
No.
given your
I'm
strong
a bit of a
taste. But
coffee snob.
yeah,
Yes, it's one of my
um,
character flaws too.
yeah. But so Starbucks had been a very poor performing stock, and some investors got involved, and that's where you get into this kind of scenario analysis where you say like what could turn this company, right? So you can look at we can take just kind of three simple screens on Bloomberg, right? We could say, well, what's the company's revenue growth been like over time? What's the company's margin profile been like over time? And how has the valuation changed? So if you look at those three things on Starbucks, you can see that they've had a revenue problem. The margins have actually not been so bad, but the revenue growth has stalled. And as a result, the valuation has deteriorated quite significantly. So if you're sitting there and you're saying, how do we restore value into Starbucks? You got to fix the revenue, right? Like maybe there's small improvements on margin, but it wasn't like sometimes margin's a problem. But when you're trying to get revenue back, sometimes you need a bit of a shot in the arm. And Starbucks went and found Chipotle, which has been a fast growing fast food chain. And this guy's a bit of a wonder kid in the industry. He's had success at a number of different firms, and they've brought him in. So when you look at the stock today, there's a couple of things. You can go back on those three graphs, and you can say, boy, when Starbucks had revenue growth, its valuation used to be this.
Okay.
So, very quickly, we could say, well, if they had full revenue growth and it went back to, call it, 16 or 17 times cash flow or mid 20s times earnings, the stock would be X dollars, say $90 or whatever it might be. So if the stock immediately went to that level, you'd say, well, we've already priced in a full recovery. This guy, he hadn't even been there a day and he's already been successful. So what the stock market tries to do is to say, well, this is a change. And we have to attempt to put odds on the possibility of a turnaround. And that's why the share price jumps, because of this guy's skill set. Now, whether or not he'll actually deliver, that will all come out in the process of time. But that is the way that the stock market tries to adjust the odds of success by taking the share price up. And what they're saying is that, this guy has more success than the management team that was in place. And conversely, on something like Chipotle, which had been a higher valued stock, immediately the stock market says, well, why is this guy leaving? Does he see a bigger opportunity in Starbucks than he had in Chipotle? So they marked the price of Chipotle down. Now, again, this will all come out with the fullness of time, but it's a great example. Just as we talked about markets as a whole, it all happens on individual stocks where the stock market needs to say, this is the good outcome, this is the bad outcome, these are all in between. We need to apply odds to the likelihood of that arriving, and we do that by adjusting valuation to these different scenarios. And when good things happen, the stock price goes up, and what that does is it pulls forward a degree of the success, and we have to say, is that appropriate? And on the other hand, they might say, well, this business is not going to be as successful. And maybe we could sit there and say, well, we think it's going to be just as successful as it was, so maybe that's an opportunity. So as share price moves, you have to reevaluate how you think about those scenarios relative to what's priced into the stock.
Yeah, and there's different things that are happening all the time that are affecting individual companies or a pair of companies, like in this case, or things economically or bigger picture, fiscal policy, government policy that affects a whole swath of S&P 500, affects all 500 stocks. Now, some to their benefit, some to their detriment, but there's also those individual cases, and for you as a portfolio manager, you're looking across every stock. But you're looking for where those opportunities are created particularly when it gets almost case to case.
100%, and that's why I mentioned those kind of three graphs that if you were going to go look at any company, whether or not you're an expert on, selling their wares or whatever it might be, and you can just say, oh boy, why has this revenue growth changed so much? Is that an opportunity? Why has the margin profile of the business changed so much? Why has the valuation changed? And within those three ingredients, that's why you find big moves in stock prices, because if the revenue growth reaccelerates, the margin expands, the multiple will go up, and those are not additive; they're multiplicative. I don't even know if that's a word, Dave, but
Yeah.
you take those three things, and they're more than just the sum. So you get bigger changes in stock prices, and that's why in any given year, you talk about how markets have, 3 times they correct by 5% and 1 time by 10% in a year. Individual company share prices often do much more,
Much more. Yeah.
because through the year you have discussions around revenue, you have discussions around margin, and as a result, you end up having discussions around valuation, and you end up with these bigger swings in underlying securities, relative to the market as a whole.
And Stu, always interests me about these, when you have a CEO change across two companies that have tens of thousands of employees around the world, right? Is it really, can one person make that much of a difference? Is the stock moving? Is Starbucks up 10% and Chipotle down percent because this guy makes that much of a difference, or are the markets saying this guy's had the ability to go and look almost on the inside of both firms, and he's making a call that for the next number of months or years he'd rather be at Starbucks than Chipotle, and they're betting on his ability to make that call, or is it a bit of both?
Well, I think it's a bit of all of that stuff. I think in this instance, um, you're probably, just the lure of turning around Starbucks is quite high. Like
Yeah.
what, and this is a generalization, but a good company is not as vulnerable to losing their leader, because if that person was a good leader, they probably had a great team. Business is firing in all cylinders. There's kind of a learned memory of how to make things work inside that business. So, and this would just be a generalization. Like, you're probably more tempted to say the reaction to the person leaving is like maybe a little bit overdone, right? Like, there's a lot of other people that have contributed to that success. When someone new joins a company, it's very similar to all sorts of situations that we find ourselves in, where we kind of know what needs to be done, but it's just hard to do it. And sometimes a fresh set of eyes can just come in and say, we know what needs to be done, let's get at it.
Yeah.
And they can do it through leadership skills, or it's not so much that they necessarily identify something brand new, they just get at it in a manner that allows the organization to kind of breathe a sigh of relief and get at what's necessary to kind of turn the business around.
Yeah, and I guess you've seen dozens of examples that have worked both ways over your career investing.
Dozens, yeah, for sure. And there's some great lines, from Warren Buffett about turnarounds often don't. And when great management meets a poor business, it's often the business that wins. So you have to always kind of be aware of there's been some great personalities that got involved in businesses that were just in tough, and nothing happened. But if you have a good underlying business that just needs a little bit of tinkering for someone to unlock a potential a value event, those are things that you definitely watch for.
Yeah, and I guess as you're out at these different companies, you're looking beyond just that leader, but you're also looking at the breadth of that management if you're going to have it as a long-term holding. Because again, at some point, someone's going to need to step up, or in the best cases, as you mentioned earlier, they've groomed someone to step up and just keep things moving in the right direction.
Yeah, 100%. And in the case of Starbucks, like the day when you do have Starbucks on the morning espresso, I will know that they have entered the pantheon of coffee shops, the Dave Richardson stamp of approval on the coffee shops, and that would likely be a sign that Starbucks' turn was at hand. Not going to
Yeah,
happen, Dave.
I mean, well, I got caught at one of my specialty coffee shops, and I have I have all the fair trade coffee and organic and very specialty coffee shops, very, very specific roasting techniques, and they've sourced them from all of the beans from all over the world. So very, very, and they actually take the time to make you a coffee instead of like they're really just kind of pushing buttons and making a coffee. So it's handcrafted in a sense. And then I one time I made a quip about Starbucks in one of these shops, and the owner went, wait, right? You have to remember this place doesn't exist if Starbucks never existed, because Starbucks took what they call the first wave, which is sitting in a lovely cafe in Tuscany, sipping an espresso out in a small little village, to being able to have that experience somewhere in North America. And then this next wave, the third wave, has taken another step and doesn't happen. It's that innovation is, and it's such a big part of our of the world, and I think particularly North American business culture.
I 100% agree. Like it's the greatest thing about business is just it's always evolving, right? There's always there's always new things. There's always a change. It's the most fantastic part about being an investor. They change the puzzle pieces every day.
And in a tip of the cap to your mom, I still think you're the wonder kid. I know they called you that one. I still think you're it.
Well, thanks very much, Dave.
All right. Thanks, everyone. And we'll see you next week on Tuesdays.
This recording has been provided by RBC Global Asset Management, Inc. for informational purposes only and is not intended to be investment or financial advice. You should consult your own legal, accounting, tax, investment, or financial planning advisors before engaging in any transactions.